Markets in Latin America have fared relatively well over the first half of this year. First, issuance in global markets have rebounded at the start of the year, driven by the public sector, as non-financial corporates cut back on their funding internationally. Second, Latin American equities in dollar terms outperformed the MSCI Emerging Market Index by 10 percentage points over the first half of this year, driven by resilient growth in the economies of the region, as well as currency appreciation in many of the large economies, with the exception, of course, of Argentina, with gains amounting in the range of 5 to 20%. And the combination of currency appreciation and high yields on local government debt have provided significant incentives for carry trade flows to flock to the regions, benefiting mostly Brazil, Mexico, and Colombia. In the second half of the year, the story has been quite different, in some ways more challenging. The region has not been immune to the sell-off in emerging markets, which saw portfolio investment from non-residents register outflows in the range of about $30 billion in August and September, according to estimates by the IAF. Besides the impact of softening growth in the region, outflows from the regions have mainly been driven by global factors. The first push factor has been the faltering recovery in China, as well as the massive sell-off by non-residents in the equity market of that country. This has weighed adversely on the performance of Latin American equities, given that stocks tend to exhibit a higher level of correlation with Chinese equities due to the fact that China has strong demand on commodities of Latin American countries. The second push factor, in many ways more critical, has been the rise in long-term yields in the US. The latter have reached new highs not seen in about 15 years, as investors have become more convinced that higher rates are there to stay. This had two effects on Latin America. First, it redirected many of the flows from the region into the US bond market, as investors found returns more attractive for less risk. That movement of capital strengthened the dollar and weakened Latin American currencies, although we've seen that in Colombia, Mexico, and Brazil, they have been able to hold on to some of their gains of the first part of the year. The second effect stems from the vital role that the 10-year US Treasury yield plays as a benchmark in financial markets. When they rise, dollar funding costs also rise through higher coupons and a stronger dollar. This situation is unfavorable for issuing debt in international markets at a time when countries need external financing to fund their energy transition. And as a matter of fact, we've seen that over the past year, about 1/3 of issuance in the region have come from green, social, sustainable, and sustainably linked bonds, which has been a record. But in this current environment, this trend is likely to be disrupted. Thank you for your time, and see you next week for a new edition of Éco TV Week.